Welcome to the Layton R&D Tax Credit webinar and how it can benefit fertility clinics during COVID-19. Thanks for joining, and hope everyone's having a good day. I'm excited to be here along with my colleague Ibrahim. We're going to walk you through a lot of fun facts and useful kind of strategies for leveraging this valuable tax credit. My name is Brandon Carroll. I have a background in technology and business development. I'm a senior consultant here at Layton, and I focus here at Layton on biotechnology, life sciences, different sectors of engineering and software. I'm also a member of the Mass Bio Association, and I enjoy some music composing and production on the side. I'll turn it over to Ibrahim to introduce himself.
Good afternoon, everyone. This is Ibrahim. I am a technical consultant here at Layton. I engage with our clients after, once we start the process with them, to evaluate the work that they're doing and start to parse out what qualifies and what doesn't. By trade, I'm a biomedical engineer. Currently wrapping up my PhD, all but dissertation, for those who are familiar with that term. My work was related to a lot of cell and tissue culture, related to extracellular matrix components of the eye and other parts of other types of tissues, skin, tendons, and so on. A lot of my work was image heavy, related to the electron microscope, and doing a lot of cryofixation or cryopreservation for my cultures and my tissue, rather than the traditional chemical fixation or preservation. But enough on that. I'll let Brandon continue with the presentation.
Excellent. Thanks, Ibrahim. So a little bit of an overview of the presentation here today. We want to introduce to you the Research Development Tax Credit, explain that, how it works and what it's all about. And then we want to go a little further and see how it applies and benefits for fertility clinics. We're going to walk you through how it works, what's the breakdown of the credit, and some examples of how fertility clinics qualify, some of the different activities that they're involved in, and also how is it calculated, what expenses go into the R&D credit and that allow you to end up with this credit. And so that's a quick overview of what we're going to be covering. So at a high level, what is the R&D tax credit? The R&D tax credit, in a nutshell, is a permanent government incentive, and it's available for companies that are basically creating or improving a product or a process that's used by their business. Essentially, it allows companies to recoup their development costs that they work so hard to do at their companies. And so the credit's been around actually since the 80s. However, it was up for renewal every 2 years. So it made it a little more hard for companies without the proper resources to go and try to leverage and take advantage of this credit. But in 2015, as a part of the PATH Act, it was made permanent. And this opened a lot of doors for both profitable businesses and also startups as well. And it basically rewards companies for incorporating new technology, creating new techniques, processes. And the whole purpose of this credit is to stimulate the economy. It's to drive job growth and really ultimately help companies accelerate their growth. And it's one of the more valuable credits left out there for the U.S. and it's a really well application for not just big pharma, but for fertility clinics and other ancillary biotechnology and life science companies. So how can the R&D tax credit benefit your clinic? So if you're paying income tax or payroll tax, you can benefit. Those are the two types of tax that you can reduce using the R&D tax credit. So we have the federal and state R&D tax credit. And so this is a way to reduce your taxes, your tax liabilities, both on the federal and state level. And it's a dollar for dollar credit. If If you owe $100,000 and you have a $90,000 credit, now you owe $10,000. So it is that valuable. They can be claimed in the current tax year, and you're also allowed to look back retroactively for 3 prior years and be refunded against any historical taxes that you've paid. And this is where it gets exciting. It's really important that all that work is not lost and you can still recoup some of those taxes that you've paid in the past. Now, for the payroll tax credit, for companies that are still operating at a loss or they're not profitable yet, each W-2 employee has a payroll tax, which typically varies between 6 and 7% depending on the state that you live in. But companies that aren't paying standard income tax yet are taxed on those payroll W-2 employees. And so this gives companies the ability to reduce that payroll tax dollar for dollar. There are a couple stipulations, a couple criteria that companies have to meet. You can only be claimed within the first 5 years of generating gross receipts. Typically, that's when the company was founded or started generating any income. And the previous year that you're looking at, you cannot have a revenue over $5 million. There is a lot of legislation to make those numbers bigger. We've seen startups grow drastically in size over the last few years. So that's something we're keeping a close watch on. All right. So show me the R&D. I'm going to turn this over to Ibrahim. We're going to get technical. And I just want to remind you as we go through this stuff, any of those that are listening, we're keeping our eyes on the Q&A section here. We want to keep this as conversational as we can. So as questions come up, we'll field those. I'll make sure that Ibrahim is aware of those and we'll answer those on the spot. So I'll let Ibrahim take it away.
All right, so the R&D tax credit, a bit different than some of the other benefits that the government has for tax-paying entities, is that it's what's called an activities-based credit. So it starts off with work, with activities, with projects that companies are doing, and then looks to qualify them under this umbrella of research and development, or a qualified research and development activity. Everybody has their definition of, or an idea of what research and development is, what R&D is. The government, thankfully, has given a definition of it, or a criteria, this 4-part test that we see on the slide, of what is R&D, how is R&D defined. And in many ways, as I'll go through this explanation, and then in the next slide, when I go into a bit of examples on what we typically see in IVF clinics, the definition is actually very broad and very inclusive. There are certain areas where it restricts it and only allows for qualification in certain types of activities or certain areas, but by and large, it makes it a bit more broad. So the first aspect of what we typically look for, this first test, the new or improved, what's called a business component. And this is when a company is endeavoring, it's working to try and develop something new or improve upon what already exists in their business. And this is business specific, not industry specific. So it can be something that you in your business, you're trying to develop, you're trying to work on, you're trying to improve upon something, but a competitor or another business has already done it. For the purposes of the credit, it doesn't matter. So long as it is new or it's an improvement, a new improvement within your business, then that's what matters. And there's 6 categories of where this is, of where this will qualify. If you're doing a new product, improving upon a process, or creating a new process, similarly with a technique, creating new formulas, software, or invention. The second test, the second and third test kind of go hand in hand. The second one is when you're trying to develop this business component, make this new product, or improving upon this process, there were some technical uncertainties that existed that you're then trying to eliminate or resolve. So the answer isn't clear right away. So it's not like you are developing a new product and you already know what the outcome is. You're just going through the steps. No, there is uncertainty that exists that you're trying to eliminate. Then the third test, the process of experimentation, is when you have the systematic method, systematic process of testing and evaluating different alternatives that you're looking at to resolve and eliminate that uncertainty. And the alternatives just have to be one or more. So you have for example, you're improving upon a protocol, you have a process that you're doing, and then you're assessing, evaluating an alternative to see if it'll bring about an improvement or not. Then the fourth and final test, and this is where some of the restrictions really come into play, but not so much where it'll affect IVF clinics. And this is that the activity to try and achieve this new or improved business component has to be technological in nature. It has to be rooted in the hard sciences. So anything where it's more so like social sciences related, on the soft sciences end of the spectrum, market surveys, things of that nature, that would end up failing this test and would then not be qualified for the R&D tax credit. The activities have to satisfy all four of these and not just one or the other. All right, so now where does this end up coming into play for IVF clinics? This can actually go through the spectrum of a lot of the work that you guys will do. Starting off from even doing, trying to develop or improve upon some of the pre-stimulation protocols, developing or improving upon some of the preservation techniques for the oocytes, sperm, the zygote, the embryo. A lot of the preservation techniques is something we see actually quite frequently. Companies are trying to figure out better ways of, one, preserving them, freezing them, and then also how to thaw them in ways that you're getting more viable cells or tissues or so on. Then again, in other areas, optimizing culture conditions, something that again can be very common in practices, in clinics, to try and get better efficiencies, get better outcomes, improving upon blastocyst conversion rate, protocols to decrease incidence of twin pregnancies. We see this quite frequently. Enhancing viable sperm separation, and kind of in general, all aspects of product development. When a company is going through a process, like I was saying before, you're trying to obtain better results, get better outcomes, and you're going through a systematic process of experimentation to test whether this method works better, that method works better, or trying to add new techniques, for example, doing genetic screenings, to see what will get a better outcome, what will produce more successful pregnancies and births. All of these lend themselves to then qualifying for the R&D tax credit. More often than not, we end up finding this being a case-by-case basis where we're working with companies to try and decide or figure out what can we qualify and to what extent we can qualify. But it is something that we find a lot. And I won't go into much about Layton right now. I'll give a couple of words about it in the end. The primary focus for today is talking about the R&D tax credit and how it fits for IVF clinics. We are, of course, a company and we love working with IVF clinics, but that's for a later part. So then the next part, once we have activities that qualify, the next step is to determine how do we make money off of that. And there are very specific cost categories that can be looked at to calculate the credit. And it's any of these four cost categories. All of these go into a bucket, and then those collectively are then used to calculate the credit. First one that we always look at is salaries and wages, and this is of W-2 employees. This goes 3 levels. The individuals that are directly doing the R&D work, individuals that are directly supervising them, individuals that are directly supporting them. And to give kind of an example of direct support that the IRS gives as guidance is people who are writing up the lab reports or lab notes of the work that was conducted, or even the people who are washing beakers, cleaning the work site. So then the people who are doing the direct work can come in the next day and go on their work seamlessly. Also that can be qualified are subcontractors or 1099s. There's a couple with 1099s, there's no restrictions. They can be qualified similar to wages. It's taken at 65% for various different reasons that the government has put that into place, but that's just the black and white letter of the law. For other contracted companies that will be involved in some portion of the work or another, there's a bit of contract analysis that has to come into play to determine whether the IVF clinic is eligible for the credit for those expenses or not. Raw materials and supplies, this is anything that is used and consumed throughout the process. What's excluded from this is any depreciable assets or depreciable equipment. Rent cannot be included. Larger pieces of equipment cannot be included. If it's used or consumed throughout the process, then those are considered raw materials and supplies, and those costs then qualify. Those would go into the bucket. And then the last category, because the R&D tax credit was initially founded in the 80s, the term that was used for this was the leasing of computers. Those of you who are around to know what this was like, computers used to be the size of a room. And if anybody wanted to do any kind of computational analysis or computing, would have to rent out and lease spaces. They have to lease the computer. Nowadays, where we see this is in cloud computing, but this only applies when a company is using cloud computing to do analysis, computational analysis for the R&D work. So this wouldn't qualify just for storing information or using software. It has to be very specific for cloud computing, for computational purposes, for the R&D purposes. And that wraps it up really for the R&D tax credit, kind of a high level nutshell, how it works, and some of the different areas in IVF clinics of where they qualify and where they don't. A big part of what we want to do is really field questions that you guys might have. The R&D tax credit is pretty broad and a lot of different activities can be included. And there's also a lot of nuance that comes into play. There's a lot that we could end up talking about, but for this webinar, at least for this portion of the R&D tax credit, I think that will suffice. Like Brenda had mentioned earlier, we both work for the company Layton. Layton is a global company, was founded in 1997, initially in France, and then grew out into 11 different countries with 27 different offices. And we work with a wide variety of clients. Now, speaking here in the US, we work with companies that are just a handful of people as a startup to much larger corporations and everything in between. Our goal is our clients to try and benefit them and work with them with what they'll be happy with. Our process is we try and make it as efficient as possible. We'll start the engagement. There'll be 2 or 3 phone calls that we'll typically have with our client. Sometimes we'll do on-site visits. Nowadays, we don't do that as much. We actually haven't done that at all during COVID. But prior to that, we would sometimes do on-site visits and have these discussions in person. We will then draft up a technical report that outlines the type of work that is being qualified and how it satisfies a 4-part test, as well as drafting the pro forma tax forms that are necessary for claiming the credit. And then we give this to our clients, and then they start benefiting from it right away. The payroll tax credit is kind of going back to a bit of the technicalities of the R&D tax credit and how the benefit is realized. If a company is using against payroll tax, then that starts coming into play right away the quarter after they file. And it has to be on a timely file. So say a company files their taxes on March 15 and they submit their R&D tax credit on or before that day. Starting April 1st, that's the start of the next quarter, they can start utilizing and using the tax credits to offset the FICA tax that comes with having W-2 employees. On the income tax side, If it's on a timely file, then it's just an instant deduction or instant reduction of the tax liability that is owed. If the company owes $100,000 in taxes and has $100,000 in credits, then they're paying $0. If it's looking at previous years and amending returns, then to the extent that a company had tax credits, and if they paid taxes more than that, or to that extent, that would be returned as a refund. So whatever you would have been eligible for in the past, that would come back as a refund check. Typically, we've seen this on average 3 months. We've seen that a couple of times come in about 2-month time period, but typically it's 3 to 4 months, and occasion it's 4 months. This part's out of our control. We wish it was, because that'd be really great and really good for our clients, but that's typically the time frame that companies end up seeing their refund checks for amended returns. But that wraps up our presentation for today. This presentation is recorded, and this will be provided afterwards. You can share it with your colleagues and the rest of your team. And at this point, we would love to field any questions that you guys might have. And thank you all for attending and listening. We have one attendee that has his hand raised. Would you like to ask your question, or would you prefer to type it out? There is a Q&A box where you can input your questions there.
Okay, so it looks like we have a question from one of the attendees. The question is, in terms of gross revenue, what's your typical company size that we work with? I could probably take this, Ebes, if you want. You know, typically company size, we're looking for, instead of revenue, we're really more concerned about total wages. As Ibrahim went over before, the wages that a company pays their staff are probably the biggest bucket that the credit is calculated on. So we like to see those wages typically $500,000 a year or north of that to start getting interesting, you know, for there to be a mutual benefit for both parties. Obviously, Layton's going to do the heavy lifting and use our kind of technical experts such as Ibrahim, and we have a financial team as well. And so that's usually what we look for. A lot of companies don't have any revenue. They're biotechnology companies that have clinical trials going on. However, they do have quite a big payroll, and that's where the credit can qualify for them towards the payroll credit. So I hope that kind of answers your question.
Another question that was asked kind of similar to that is on maximum annual revenue restriction. There is no restriction on the maximum of what it can be. For the payroll tax, there is one restriction. For the payroll taxes, because it's meant for the payroll tax credit, it's meant for newer companies and smaller companies. The company has to, there's a clock that starts when a company first starts generating gross receipts, and that's a 5-year window. There's actually stuff that's going on through Congress that's trying to extend that to 10 years, but currently it's at 5 years. Once a company starts generating gross receipts, and that no particular year has more than 5 million in gross receipts. If it goes beyond 5 million, then that gets reduced, or it's no longer eligible for the payroll tax credit on that year. But for the income tax credit, the sky's the limit. There's no restriction on maximum revenue or maximum credit. I hope that answers the question.
That's a good point, Ibrahim. Looks like we have another question, and this is probably more for you, Ibrahim. This is kind of around the raw materials that fertility clinics could use towards expenses, and possibly cloud computing. Maybe you could speak to a little bit of that. I would imagine materials are probably more of a focus than cloud computing, and unless they have some type of platform they're working on.
Yeah, so far I haven't seen in the IVF clinics that I've worked with and my team has worked with, we haven't seen cloud computing being any significant cost. In terms of raw materials, and so the question that's being asked is, are raw materials or cloud computing costs ever a significant portion of the qualified expenses for IVF and fertility companies, or is it usually primarily salaries? And yes, that's correct. Primarily it is salaries, but the raw materials have actually been quite significant. The last couple of ones that we've worked on, I think it was in terms of the qualified expenditure, it was, I want to say 70% salaries, 30% materials. But yes, by and large, it'll be the salaries that end up making the biggest part of the qualified expenditure. And we have another question. It says, we had to switch culture medias and we've been evaluating products from different suppliers. Would the cost associated with this count towards the credit? So yes, if a company is trying to improve upon their culturing process by trying different medias, different formulations of the medias, different compounds or components within the media to try and get better outcomes, this does qualify. And then the cost associated to it, what we typically end up finding is the staff that are running the credit, the staff that are running these experiments, they would qualify. The materials that would go into it, media doesn't typically cost very much. But if it's something that is being used on a very large scale, any of the costs, any of the supply costs that would go into it, those would also qualify. And then any supporting staff or supervision that's also being performed, their time associated to that work would also qualify. And I hope that answers the question. Okay, so another question was actually asked that is quite an important one to note. The question is, I don't have current tax liability. Will the credits go to waste for that year? So the R&D tax credit, again, it only offsets taxes to the extent that there are taxes. So for example, a company has to pay $50,000 in taxes, but they have $100,000 in credit. They can only offset 50,000 and the remaining doesn't end up being given back as a refund or a cash check. Those end up being carried forward, and they're carried forward now indefinitely. Previously, there used to be a 20-minute lifespan, a 20-year lifespan for the rollover credits or the carry forward credits, but now it's been changed and it's an indefinite carry forward. So any unused credits are carried forward in future years, or if, for example, a company can't utilize credits at this time, then again, they remain on their books indefinitely. This is actually particularly important for newer companies and smaller companies. Those are eligible for the payroll tax credit because there is just that 5-year window. And just because of the nature of IVF clinics and how you guys operate, you're generating gross receipts almost immediately. I mean, it's part of the business model. So that clock will start almost right away. And then you only have 5 years to capture the payroll tax credit, and then it's gone afterwards. So those would be really prime years to make sure you're claiming the credit and getting those on the books, even if you don't have a use for it in the immediate. All right, there's one other question that I'm seeing that we haven't answered yet. And this is related to what seems to be a new piece of equipment that was purchased in part of the work. a humidified incubator. So the incorporation of a new technology to try and get better results, that the activity can qualify, and the time spent trying to get those results can qualify, but the cost of the equipment cannot. Now, incubators are depreciable assets. Even if a company is not depreciating it, it is a depreciable asset, and that cannot be qualified. Their cost cannot be a qualified expense. So the activity that goes into trying to get better outcomes to improve upon the process, that can qualify, but the cost of the equipment itself would not qualify. All right, there's a question on sending out samples to external labs for genetic testing. This is where that contract part comes into play. That contract subcontractor cost category. So very often in almost all science, life sciences related companies, not one company will do everything. So in this example, where a company has to send out some of their samples, in this example, some companies will send out their cells or their tissue samples, their zygotes to get genetic testing in external labs. Those costs can qualify only if excuse me, only if specific qualifications exist within the contract between them. If the company is paying their subcontractor a fixed fee, and this is me just simplifying it, and we'll leave the contract analysis to our legal team, but in a simplified answer, if a company is paying the external lab a fixed fee to do the work, then that cost would not qualify. If they're paying them in a time and materials type of arrangement, then that would qualify. It's the company that bears financial risk that ends up being eligible for the credit. Additionally, on top of that, one of the requirements is that you own the IP of the work that's being done, or the IP is shared at the very least. In that case, those costs are now eligible. All right, any last round of questions before we wrap up for today? All right, thank you everyone for attending. Really appreciate your time and appreciate you listening to us and asking us your questions. The presentation, like we had mentioned, is recorded and will be sent around for all the attendees, and will probably be also posted on our social media, our LinkedIn, and so on. Thank you all for your time and have a great day. Take care.
Thank you, everyone.